What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is August 19th of 2024. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we're going to do a massive Macro Monday update on all things Bitcoin, altcoins, the stock market, and talk about one of the most quintessential topics we have yet to discuss for some time in this channel, and that is monetary policy. Something that has been relatively stagnant and unchanged is set to make big moves in the next month, where the Fed is going to be changing direction and course on its monetary policy. I want to talk about what that could mean for markets and how we can best prepare for that scenario. We got a lot to unpack here in today's video, so if you happen to enjoy it, consider dropping a like, and let's go ahead and kick things off. So I wanted to share one thing with you guys real quick before we dive into the Bitcoin price analysis. I know a lot of you like following Russ's content, as well as myself here on the channel. And if you guys are interested in seeing an upcoming presentation from Russ, as well as a lot of really great speakers at an upcoming event known as the DePIN Revolution, which is going to be starting later on this week, then definitely check out the link down below in the description where you can learn more about the event. I wanted to let you guys know that we're doing a partnership with them, as Russ is going to be giving his presentation there on how to essentially win out against 90% of traders who end up losing money, how to actually become a successful trader and build a solid risk-adjusted strategy to win out in markets. If you're interested in getting discount tickets, you can sign up for a monthly subscription on the Dash Report and get a 50% discount ticket for the DePIN Revolution. Or if you sign up for an annual subscription to the Dash Report, you will get a free ticket to the event. So this is a partnership we did with the DePIN Revolution event. Russ is really excited to be speaking at the event later on this week. If you want to find out more details about who's going to be presenting there alongside Russ, then definitely check out the website. There's a ton of different really valuable people who are going to be speaking at the event from different projects and different parts of the broader crypto ecosystem. But definitely check it out. I hope you guys will join in and see Russ's presentation. I think it's going to be a really great oversight on how to become a successful trader. And if you haven't already, start checking out his content, guys. He's got a lot of really great stuff on the channel. All right, so let's go ahead and kick off the rambling here when it comes to Bitcoin. Now, I want to go ahead and emphasize that right now, guys, price action is showing some pretty bleak signs here. And this is going to, again, kind of play in what we're talking about with how assets are going to perform in a broader change in monetary policy for the Fed. The big thing I want to emphasize here is that just from a pure price analysis perspective, right now we are still facing consistent resistance for the last really coming up here on 11 days, more than a week and a half here for Bitcoin against that 21-day moving average. That 21-day pocket, we have not gotten one daily close even into the pocket yet. Every time getting shot down here, and we are now back below the 200-day moving average. We're spending the majority of the time over the last week below the 200-day. This is not good, guys. This is really not a good thing to see in price. And again, I keep echoing this point here. And I'm gonna beat it like a dead horse, but until we can really get momentum coming back into Bitcoin, I'm not here to try to pick bottoms or try to make short-term trades. I definitely recommend, if you want to make those kind of scalp trades, follow Russ's videos. He is going to give you the tools and prep to be able to really handle that. In the Dash Report, he also gives actual trade alerts out that you guys can follow and kind of copy trade alongside and learn from and implement your own strategies. But the big thing above all is that if you're like me and you're wanting to buy positions for the next couple months in altcoins where you can really make the big returns, or maybe even in Bitcoin, right? That's fair. Okay, what we need is momentum here. I'm not interested in buying here 58,000 where we've been pretty much stalling and are much lower from where we were back here in March. What I care about is getting back above those prior highs. If we can't really get above there and really pioneer a new bull market, so to speak, a lot of people were calling this already a bull market. I don't know how confident I can say I am and that this is a new bull market if we can't clear above that range from the prior highs back here in November. Of course, we went a little higher, but we're pretty much chopping here. So unless we can really confirm this prior resistance in the past as a new base, so to speak, and really slingshot here and get a weekly close above the $72,500 target, which we talked about, then I'm not really interested. But that doesn't mean we shouldn't be prepping for opportunities in the market. The big thing I just want to echo here, which is important to keep in mind, is a chart that I don't think many people talk about very often, and that is the Bitcoin to NASDAQ ratio. Now, a lot of people might wonder, why would we be dividing Bitcoin by the NASDAQ? Don't we usually just look at it in dollar terms? Or how do we, don't we generally look at Bitcoin against other altcoins? Yeah, those are all valuable metrics. But I think what's really imperative here to understand is to talk about something that isn't discussed very often. And that is the normalization of returns in Bitcoin. Bitcoin is no longer this little niche asset that no one really knows about. It is a very well-known, readily accessible asset. If people want to buy it today, whether you're a family fund or hedge fund, whether you're Joe Schmo down the road who's working a blue-collar job or white-collar job, it doesn't matter if you're an investment bank, it doesn't matter if you're a pension fund, all the liquidity in the world pretty much at this point has access to Bitcoin. And therefore, we need to start trying to measure Bitcoin in regards to its returns, not so much just in dollar terms, but how it's performing against other assets. Now, a lot of the headlines will tell you this year in 2024 that Bitcoin has obviously outpaced the S&P 500 and the NASDAQ. And they're right. Technically, Bitcoin has this year, and that is mainly due to the fact that we have the Bitcoin ETF. We had a really stark correction in 2022, most of which was really made up here in the later part of 2023 and 2024. So this is why Bitcoin, again, headlines are reading that Bitcoin has got the best annualized returns. This year it does, right? It's a positive year, but by how much? And this is really what the cusp of what I really want to get to here. If we take a look back through history, from bull market highs against the NASDAQ, we can see that from absolute rock bottom when Bitcoin started, I mean, we just had immeasurable returns. This is just not even really, it doesn't even really make sense to use this sometimes. So I'm just, again, marking it here in the chart, but a 411,000% return, getting it from that low range to the highs, okay? Then we take a look here from that prior all-time high in June of 2011 here to the new highs in November 2023. That was the bull market high before the Mt. Gox collapse. And we see still phenomenal outpacing of the NASDAQ, right? 2,560% against the returns you would have gotten against the NASDAQ during that period of time, right? And mind you, during all these kind of bull markets and bear markets in crypto, the NASDAQ has been in an uptrend, right? So we don't really need to negate, oh, what's the NASDAQ during this period of time, right? Those changes are negligible because Bitcoin is just making absolutely accelerated returns. Here we can see 786% outpace. It took a long time, longest time in its history, but from November 2013 here to December of 2017, over 4 years, we had a 786% expansion coming up on a 9x for Bitcoin against the NASDAQ and its overall returns. Still life-changing stuff. Decaying returns? Sure. Still amazing? Absolutely. Here, since 2017, I want you guys to really take this chart to heart here, because this talks about something we've discussed here in this channel, and it is something that I want you guys to keep in your mind when you are setting expectations for crypto, because a lot of people have this idea that we are still early, that Bitcoin is going to be this multi-10 trillion dollar asset, it's going to flip gold, it's going to be the world reserve currency. Watch a couple Michael Saylor speeches, CEO of MicroStrategy, and you get the picture, right? So again, from 2017, right, Bitcoin is definitely up. It was a high of around $20,000. Then right now, Bitcoin is trading in the upper $50,000 range, okay? I'm not saying that Bitcoin's down from that period of time. What I want to emphasize is that to the highs in March of 2021 against Bitcoin, and actually technically the highs for Bitcoin were actually here in October, November 2021. But the main point I want to echo, irrespective if you choose one of those highs or the other, we had a roughly 62% increase against the NASDAQ. Now, that's still a broad outpace from one high to another, but we need to keep in mind that that is over more than 3.5 years, well over 3.5 years. And beyond that, right, so similar expansion period to back here, right? But beyond that, only 62%, 63%. We can argue on the specifics, doesn't really matter. This is less than 1/10 of what we got in the prior bull market high expansion. Not really good to see. Barely a blip on the map here. And if you want to make matters worse here, what we're really seeing is that from those highs in 2017, and I understand, yes, if you bought here at the 200 week, if you played the smarter game here on either of the bear markets, you're making some great returns, you're outpacing the NASDAQ, sure. Buying during periods of fear are going to play out better for you. But what I'm here to say is that from that 2017 high, we're only up roughly 10-15% against the NASDAQ since the highs of December 2017. Guys, that is coming up here in a couple months, that'll be 7 years ago. So right now it's about 6.5 years ago that people who bought at those highs have not really outpaced the NASDAQ. Now, of course, the NASDAQ has gone up during that period of time, and therefore Bitcoin's gone up. And again, I'm not here to say that, therefore, have your money in a bank account getting 5%, right? What I'm here to say is that the exponential returns that people expect from Bitcoin may not be coming back anytime soon. And this is why, again, I keep echoing that, while there's a chance Bitcoin could break out and go to 100K in this side, we could really have a new bull market expansion, just might take more time. While I do believe that 100K can be hit, I believe Bitcoin could go eventually to 200K and much higher valuations years down the line. It is not where I believe you're going to make life-changing returns. I think it's alongside assets like stocks, like property, is going to become this asset that slowly but steadily may continue outpacing equities possibly a little bit, but it's not going to be something that knocks your socks off and really changes your life, right? Instead, I really want you guys to continue keeping your eye here on the altcoin space and not on the large caps. I also brought up here just to show you I'm not just bashing on Bitcoin. I love Bitcoin, right? I think Bitcoin's one of the most resilient long-term bets. But if you're looking to make short-term multi-month trades and make life-changing returns, then I think you're going to find that in the broader altcoin space. You're not going to find it in Bitcoin. You're not going to find it in Ethereum either. Take a look here at ETH, right? Almost just as bad here. Since back in January 2018, from those highs against the NASDAQ, we are actually below that range, right? Now again, not to say here that if you bought, below, like deeply below the 200 week or something, similar to like back here, right? Maybe you get an opportunity to buy at the 100 month. Maybe then it's a little bit more favorable. Maybe you can make a multi-month swing and outpace the NASDAQ. I'm not really focusing. I'm talking about setting our expectations for life-changing returns. I think that is going to come in the form of the broader altcoin market. So why do I echo this point that we should have our attention on other coins or the broader altcoin market, all cryptocurrencies kind of excluding the top 10? The reason why I emphasize this index or this kind of sector of the broader crypto market, even though, to be fair, if you were to divide it by the NASDAQ, you would probably get a similar chart that it aligns pretty much back to its 2017 or early 2018 highs from 2 bull markets ago, right? Similar to Ethereum. So why do I keep putting an emphasis on this? Because while other coins are generally going to play to the gravitational pull of Bitcoin, it's only going to generally go up if Bitcoin goes up, and vice versa. If Bitcoin goes down, altcoins usually get dragged down. The reason why I keep focusing attention on this is because this is where the trading opportunities are. We're talking about individual plays in this category because other coins is so much broader. It is the thousands upon thousands of cryptocurrencies, many of which are small and mid caps, many of which play into exciting new narratives in the space, and that when risk taking comes in are going to be some of the best returning plays in the market. When liquidity, new buyers come in, and we start to see an upward trend. I'm not saying that that's guaranteed, but once we see those signs of momentum come in, this is where we want to put our focus. We do not want to get trapped just buying Bitcoin or Ethereum, which are going to have very minimal returns. We may very well, if we play our cards right, be able to make some serious life-changing returns. Plays in which can do 3 or 5x, 10x, 20x, 30x, depending on which plays you get in and at what time. Of course, even if we can get on the lower range of those kind of multiples, that would be very exciting. When I take a look here at the chart in the short term, I see that we're coming down here testing that 200 week. This is a big psychological level, but to be fair, we have yet to clear through that 21-day moving average. This is an imperative thing that we need to do in order to really start trending higher. We need to get above that 21-day moving average. We need to make it support, unlike the prior 2 times where we got above it and failed to do that. If we can start to make support on the 200-day, the 21-day moving average, if we can start to really trend up and test these longer term moving averages here, this could be a sign, especially alongside confidence in Bitcoin and Ethereum, that we are ready for altcoins to really kick up again and start providing some really awesome opportunities. And while it is difficult to really scope out and find exactly which plays to buy, I think one of the strongest narratives that you can keep in your radar, one of the most consistent with each bull market, is the focus on layer 1 protocols, alternative L1s. Plays like Solana back in 2020 and 2021, Ethereum even back in 2017, not to mention the slew of different protocols that offer new unique feature sets that allow for new types of applications to be deployed that weren't available before due to new technological advancements, consensus mechanisms, features, and programmability that weren't offered in prior programmable chains before. These are the kind of things that I think are really going to be some of the best consistent plays in the market. Plays, for example, like L0, which is one of the only L1s in the crypto space that's actually going to be able to provide real privacy, enterprise-grade privacy for a variety of applications that have just been waiting to be built and deployed in the space, like enterprise DeFi, as well as enterprise real-world assets, as well as DePIN, a whole range of things that we have yet to really see. Beyond that as well, we've also got Radix with its programmable language, Scripto, which is asset-oriented, which is going to allow for dramatically simplified developer time to deploying great ideas. These are the kind of protocols that, again, really get me excited. They're at market cap ranges that are incredibly favorable to start taking risk in the event of having that kind of fractional exposure for a broader move. And along with that as well, we've got plays like Constellation or DAG, which is our sponsor for today's video. Now, Constellation is a project in which I've covered or I've talked about since as far back as 2018. From time to time, I've been following the project, and there's a reason we're covering them here on this channel because, like the protocols we mentioned, like Radix and LF0, Constellation does have some interesting fundamentals when it comes from a technology perspective as a protocol. Now, for those who don't know about Constellation Network, as I mentioned, it's been a project in the crypto space for some time. It's really stood the test of time versus a lot of protocols, and the team, through bull market, bear market, has continued to build and is really honing in on building a network that's specifically focused on enterprise grade narratives like tokens, like DePIN, like AI and IoT. And the big thing about these different areas that Constellation is focused on is it has the architecture as well as the exciting updates to really deliver for a lot of major enterprises like IBM, as well as the US Air Force, Foursquare, and a ton of different major companies like Snowflake. Now, I wanted to go ahead and talk a little bit about some of the key technologies of why, in this case, Constellation or DAG, native token, is a really big deal in my opinion, and why it has definitely the rights to kind of be a protocol of interest on our radar. The reason why is because it has a big emphasis on a technology known as metagraphs. Now, many of you probably know, if you followed DataDash for a long period of time, I talked a lot about smart contracts, oracles, way back in the day in 2017 when it was still a relatively new concept. But metagraphs are an interesting technology as well. While it is definitely more of a novel concept, and one of the reasons why I do like Constellation Network as a protocol, the major thing is that the traditional combination of smart contracts and oracles are great for pulling data from external sources where blockchains are usually generally siloed. But in this case, metagraphs are really focused on allowing for a whole range of new use cases and sectors that couldn't previously utilize oracles for their blockchain applications, where you can do massive data churning, data pulling from the external world, real-time data, things, for example, like the Internet of Things, where you're pulling weather data or traffic data, maybe even as well for supply chains, being able to track thousands upon thousands of products, and being able to utilize that in a directed acyclic graph architecture, which Constellation uses, which allows for much higher throughput and scalability for these different use cases. So metagraphs are really interesting technology, but beyond that, there's going to be a major hackathon event that's coming up, with already over 500 developers signed up to participate in the event, utilizing metagraphs to build exciting applications, alongside partners like Panasonic and IBM, who are going to be helping to contribute to this upcoming event, which is giving over $100,000 in prizes to these over 500 plus developers who have registered for the event. So I definitely recommend, if you guys are developers and you're interested in participating in this, definitely check out their major post. It's at metagraph.devpost.com if you want to participate and learn about some of the key focus points of the overall event, some of the prizes, as well as some of the supporting hackathon partners like IBM and Panasonic. But beyond that as well, this is also coming at a really interesting time when the project Constellation is making some really big updates to its token economics. This is probably just as big, if not bigger, than the hackathon event, in my opinion, as it's going to set the foundation for Constellation to really be able to survive over the next couple of months and years and really stand out alongside some of the larger players if it can really hit the tone here with building some awesome applications of metagraphs. Essentially speaking, Metanomics, the new tokenomics upgrade that just recently got released for Constellation, is all about focusing on trying to mimic the success of networks like Solana and building a nice, stable inflationary model that, while it is inflationary, is going to allow for the protocol to sustain itself and really get ecosystem development driven over the next couple of months to hyperdrive, essentially focusing in on rebuilding the treasury. So this is going to give them a whole range of resources in the token economics for scaling operations, community incentives, and grant programs similar to the hackathon event that's going on now, as well as employee incentives and marketing and network adoption. So this is a big part of it here, but beyond that as well, it also brings in the introduction of what is going to set demand for the DAG token. It's one thing to talk about, basically setting the foundation to get Constellation network off the ground and get people utilizing MetaGraphs. It's another to talk about how you're going to set demand for the token. And one of the big things here is snapshot fees. Alex Brandis, who is the CTO of the project, essentially made a post talking about the snapshot fee mechanism, which is launching the protocol. And this is essentially going to set demand here for DAG. And the way it works is that when you're using MetaGraphs and you're pulling all this data and you need to have it verified to the core layer 0, or essentially the main chain, this is going to set demand for DAG. There's a cost for processing that data, and it's paid in the form of DAG to validators. So essentially, the more people are bringing in data and input and utilizing Constellation for real-world applications, then in this case, you're going to see that demand for DAG come in. So if you're interested in diving into the token metrics, you can also dive into Hacken's token economy review that they did. They're one of the largest auditing agencies in the crypto space. That would be a really great place to start. But you can also scan through some of the ecosystem projects that will help to give you kind of an idea of where the ecosystem is right now and some of the use cases that are utilized on Constellation versus other networks. They also have a calculator as well on their website that talks about the fee mechanism as well for snapshots. And that can really give you an idea of, if you start seeing 2, 3, 4, 5 major enterprise applications utilizing Constellation Network, what's that going to look like for the token demand DAG? And really, if this starts to continue budding out, I think that that's really an interesting thing for me personally. But above all, you guys can follow them over on Twitter. Check them out. They're at Constellation with the L's spelled as ones. If you guys want to follow them, I think it's definitely a project you should keep on your radar. It's not financial advice here. I'm not telling you guys to go and buy Constellation or the DAG token. Take a look into it. If you find excitement in it, then you can consider maybe buying some of the tokens. But above all, the big thing is just to keep focused on the project fundamentals. Keep these projects on your radar. Keep them on Twitter. And make sure that you have that idea of what plays could be ones that are deserving of being on your radar that could really take off in a broader altcoin cycle and with further adoption of their technology. Last but not least, I wanted to go ahead and step a bit outside of the crypto space. We will tie it back into crypto a little bit, but I want to talk about the macro environment here, guys. Monetary policy. Again, monetary policy has been relatively unchanged for the last year and a half. We haven't seen much significant changes in the Fed funds rate. Balance sheet reduction has been just kind of playing out as per usual. And what we see here is now that the Federal Reserve Chairman, Jay Powell, is essentially talking or hinting, potentially up here on this presentation is going to give on Friday. There's a lot of people looking forward at Jackson Hole, this big annual meeting that happens in the month of August or September, where essentially the Federal Reserve may go out and start giving hints that in September there could be a rate cut. Now this is a really big thing because while a lot of people focus many times on the balance sheet, either the reduction or acceleration, cutting interest rates by 50 basis points, 100 basis points, even 25 basis points has a pretty significant stimulatory effect on markets. And of course, the bigger you go on that, if you're talking about 100 basis points or a percentage point, a drop in the Fed funds rate, you're talking about hundreds of billions of dollars, if not trillions, in added benefits for liquidity and asset prices and the broader economy. So I think it's very imperative that we keep an eye on the Fed's decision here, because that's essentially, I think in many ways, what the market is responding to after this kind of flash crash we had after the rollback of the carry forward trade. A lot of people got liquidated and knocked out trying to bet against the Japanese yen. That has basically recovered since then, and we are not far away from all-time highs in the S&P 500, which, bear in mind, is not the same story here for Bitcoin. We're not even back to where we really were here before that flash sale back around $70,000. We're still about, in this case, coming up about $12,000 short from that range. So again, Bitcoin has made a nice recovery off the lows, but not as confident and directional as we're seeing in the S&P 500. So we'll talk a little bit about that kind of asset comparison here later on. The big thing I wanted to talk about, though, is that we can see markets are already starting to price in what we're discussing. So while we've had a little bit of a rebound since the carry trade unwinding against the Japanese yen, we are still down about a percentage point from where we were back here in May of 2024 at 5% down here at 4%. And it looks very much like we're going to struggle at that 21-day in the markets over the next couple of days. If the Jackson Hole presentation later this week signifies the Fed being more dovish in this case, starting to provide more stimulus to markets, inflation is cooling down, then we could really start to see this come down back to those prior lows at 3.6% or down to 3.4% on the US 2-year yield, which is directional. It's signifying the Fed is likely going to be cooling off on its monetary policy tightening that it's been holding to for the last few years, and that we could be dropping here from an estimated 5% on the 10-year yield down here towards 3% for the 10-year yield. Essentially, this is all following expectations for the Fed funds rate and where markets believe the Fed is going to take interest rates. We haven't seen since 1994, I mean, of course, outside of a couple of anomalies where we went up to around 6 to 6.5%. This has generally been the ceiling for interest rates over the last 3 decades here, more than 3 decades of price action. Well, not so much price action, but basically data that we have here when it comes to interest rates, right? So we can see here since back in July, that interest rate has held neutral. So it's been over a year now. It's crazy to think it's been a year since that Fed funds rate has moved. It's been staying flat. And usually, as we see throughout history, that extended window of time where rates have been heightened and flat is usually enough to cause that stunt, and that's usually when the cuts start to begin. Now, I want to make one thing very clear here, guys, which is that there is a misconception that a lot of people have, is that because a lot of people really started trading during the COVID era, where we had this kind of sharp drop in interest rates back down to 0%, we had a ton of money printing. A lot of people believe that interest rate cuts are generally a bullish thing because it does make logical sense, right? It is an event when you're making credit much cheaper, like the cost to borrow, and generally is going to come with some kind of balance sheet expansion or maybe some kind of pause on the reduction of the balance sheet, which again is beneficial. But at the end of the day, guys, this is usually in response to the Fed predicting some form of recession or pullback in markets. So we don't want to be too certain that this is an absolutely bullish event for all asset prices. And I think that this is also a good reason why we're seeing Bitcoin, and to be fair, as we talked about earlier, other coins, Ethereum, still struggling at long-term moving averages like the 200-week. I think there are 2 reasons why this is happening here. First off, the general fundamental excitement from like an actual belief system of where crypto can go, what it's doing, the fundamental innovation that's going on in the space is probably at its weakest point versus prior cycles throughout its history. And I think the price action is quite indicative of that. And the narratives that have been really taking off here over the past couple initial months of what may be a further bull market, meme coins, you name it. But beyond that, I think it's imperative to understand here that just because interest rate cuts might actually be bullish for the broader swing of assets, in stocks and property values, it does not mean right away that it is going to be enough to sustain crypto valuations. It might prevent Bitcoin from, say, going down to its 200-week or 100-month and really going through a major flush down, but it may not be enough to really accelerate it to new highs right out the gate. That's a very imperative thing to understand here, which is that even with that Fed rate cut, we might need real balance sheet expansion in order for Bitcoin's price to accelerate. I don't think it's a coincidence that during this window of time in 2014 when we had balance sheet expansion, or here in 2020, right, throughout that window of time, as well as the continued expansion in 2021, that this is when cryptocurrencies were doing phenomenally well. Right? When we had this huge expansion of money during this window of time, this played to a huge benefit in Bitcoin's price because the broader M2 money supply was expanding rapidly during this period of time, right? But for the last more than 2 years, since February 2022, so it's been kind of on 2.5 years, global M2 has been practically break even. It's been neutral. So there hasn't been this kind of monetary expansion that we're used to, this broader general uptrend line that usually plays out over time. So again, I think this is why we're obviously seeing inflation cool down to some extent. course, maybe the numbers are a little bit fluffed by the CPI or the Consumer Price Index from the Bureau of Labor Statistics, right? Other governments might be doing the same. But as we talked about a long time ago, we kind of had either, one of few targets coming down and closing down the secondary wave of COVID balance sheet expansion, or coming down here in a more bearish scenario down here to this range somewhere kind of in the middle. Those are kind of three ranges here, and it looks like we're going to hit that more moderate target here we already really technically have, cutting down the balance sheet by nearly right under about $2 trillion. So this to me is a sign that the Federal Reserve can start to cut interest rates, which is generally going to be, again, a stimulatory thing. It's good, but we may not be in a position where we can really expand the balance sheet, right? The Fed, as it did back here in March, when we had the bank run in 2023, they expanded temporarily and continued that reduction, right? Providing enough time for banks to rebalance, to prepare themselves. And again, I don't think there's many reasons right now why the Fed could really expand that balance sheet. If we don't have that huge injection of new liquidity, then the Fed funds rate getting cut a couple basis points down to, say, 4 or 3.5% over the next couple of months, the next year or two, that's not going to be massively beneficial for more risk on assets like Bitcoin or other coins, right? It may very well not be enough. So I just echo to keep that in mind here when it comes to the decision. I do believe that the Fed is getting into a position where, for better or for worse, it's going to start cutting interest rates. I do believe the market is properly repricing that. When I take a look at the bond markets and the yield change, it looks to me like the market is expecting that this is going to move lower, with the kind of prior support range here acting as resistance, right? Again, we are well below our long-term moving averages. Historically speaking, when this kind of drop happens, you just look at the trend with the moving averages, that's your sign, your initial sign that we are on the downward trajectory here, right? Putting aside our emotions and what we personally think and stuff, when you break that 200-day to the downside on yields, that is either an initial sign or already the sign that we are on the decline for interest rates, for monetary policy. So keep that in mind here, right? Keep it simple. Moving averages are your friends. And, that's again why I think you're seeing a little bit of a separation between the price performance in equities and the price performance in crypto. It may very well be that the benefit plays out much more to equities here. And that's again why I brought up that ratio between Bitcoin to the NASDAQ. Like, we either got to look for those really solid, high-yielding plays in the altcoin space with strong fundamentals that could really take off, that are going to be leading new narratives in the market, right? Or we got to look for plays, new market leaders in equities that are going to be providing the best returns that we can chase. So that's it for today's video, guys. I hope this video proved valuable for you. I hope it gave some food for thought on kind of where to keep your focus on things. If you happen to enjoy this video, consider dropping a like. Again, if you want to consider checking out the Dash report, not only will you get the benefit here, signing up for the newsletter at this time with the DPIN Revolution event, and you guys will get a free ticket if you sign up for an annualized newsletter. It's less than $1 a day, less than a cup of coffee, especially if you drink Starbucks. That's a couple DataDash subscriptions if you drink Starbucks on a day-to-day basis. And along that as well, you get a 50% discount on the DPIN Revolution. And don't worry, if you sign up for the Dash report, you won't have to deal with my terrible humor. Okay, maybe sometimes you will. I hope you guys have a phenomenal rest of your day. Take care, everyone, and I'll see you all in the next video. Take care, everyone.